Okay, welcome everybody to this week's presentation of the International Macro History Online Seminar Series. We are pleased to have Seung Lee here from University of Oxford talking to us about the spatial transmission of the US banking panics, evidence from 1870 to 1929. The typical rules apply, so we'll listen to the presentation for about 40 minutes, and then we'll open it for Q&A. So if there are any questions from the audience, feel free to type them in the Q&A. With that, I'll turn it over to Seung, and looking forward to the presentation.
Sure, let me share my screen first. Do you see my screen? Hopefully you can.
Yes.
Okay. So thanks for having me. My name is Seung Lee. I'm working at the University of Oxford. So this project is joint work with my friend from grad school, Marc, at Hong Kong University of Science and Technology. So the title is the spatial transmission of the US banking panic, evidence from 1870 to 1929. So this paper is about banking panic. Actually, if you look at historical context, banking panics were quite common during the national banking era up to 1913 and the early Federal Reserve System era, after 1913. So on average, if you look at the data, banking panic happened once every 4 years during 1870 to 1930, right before the Great Depression. The problem at that time was that, we in the United States had unit banking system, which means that each bank had no branch outside their state border. So they could not expand their business. But the economic size of the United States was growing quite fast. Banks had to rely on their own market, which we call interbank market. And then, institutional, aspect of this interbank market was like this. So there was a pyramidal structure of reserves across. First, there were three central reserve banks, New York and Chicago and St. Louis. And then there were some reserve banks, reserve cities, and then there were countryside. So banks in central reserve state had to have 25% of their deposit as cash for reserve. And then those in reserve cities could also had to have some reserve up to 25%, but they could have half of them into a deposit at the central reserve banks. And the countryside banks also had to have 15% of their deposit as their reserve, and then they could deposit their deposit into either banks in reserve cities or banks in central reserve cities. So here's the question we ask in this project. We actually ask about spatial transmission of a state-level banking panic. For example, how exactly did a banking panic in one state, in state like New York, propagate to state like California? And we are curious about the severity and persistence of this spatial propagation of a panic across different states in the United States. And then we want to kind of provide a conceptual framework or theoretical framework about why interbank markets could create this spatial transmission of a panic in a state border. Okay, so our contribution is that we provide a novel theoretical framework for understanding interbank lending market, and for the empirical side, we provide a quite, I think, convincing identification strategy for spatial spillovers of a state level banking panic across different states in the United States. Okay, so here is a big kind of conceptual takeaway from our theoretical framework. So interbank market is quite good on average, okay, but it poses a key trade-off. Of course, it allows banks to access cheaper funding because they can go to interbank market and they can choose the best rate for them, which can allow them to sustain higher credit levels in general, which is good because the US economy was growing quite fast. And then, of course, the level of credit necessary for sustaining the economic level was quite high, right? So interbank market was quite good in terms of raising the supply of credit. The problem was that this interbank market exposed banks to risks of runs and panics outside their state borders, from which they would have otherwise been insulated by the unit banking system because they didn't have branch outside their state border. But right now, because they have kind of exposure to this interbank market, so something happening like in very far state could have affected by financial help as a bank. So this kind of interbank market could allow some state level panic to be transmitted to different states, which we confirm by the data. That is what we do in this project. Okay, so there is large literature on banking panics. And for example, like Jolly's 2015 paper is actually classifying all the panics, which we will discuss in a minute, classifying all the major and minor panics like across different states. And he estimated the quantitative impact of major like nationwide panics on industrial production and prices, and found like significant effect on the real economy. And like there is another literature about this importance of correspondent network, which I explained, and pyramidal structure of reserves during the national banking era and the early Federal Reserve System era, including the Great Depression. For example, like Michener and Richardson paper in 2019, they found that interbank market actually amplified the effect of Great Depression up to really, really significant level. And then, so basically the intuition is quite similar, but we look at like spatial transmission of a state level banking panic instead of like Great Depressions, which engulfed the entire United States. In terms of modeling side, we have our earlier paper, which we borrow insight from. And then I think our theoretical framework can be applied to different contexts in a quite general way. So I'm happy to present this model. But before I do present my model, like I want to explain the data. So we collect banking sector data from annual reports of the Office of the Comptroller of the Currency, and we look at their abstract report. So there were like 4 or 5 core reports per year for all the national banks. Okay, and all the national banks had to report their financial health, their balance sheet, and their balance sheet category size and every information to their, like core supervisor, which is Office of the Controller of the Currency. And then, there were 4 or 5 core reports per year. So we could kind of make it quarterly in a sense that, for example, like if we have some core report on February 1st, we kind of count it as first quarter. But in case like there are 2 observations in the same quarter, we pick one that is closer to mid-quarter or some panic if there is, okay? So one great thing about this is that, because we care about like state level financial health, so we want to have some level of deposit in state like New York instead of like individual bank, right? So Weber 2000 book actually already digitized the similar series for 1880 to 1910. So we actually look at how he digitized this data series, and then we digitize ourselves like the rest, okay, in our sample period. And then, of course, you have to think about like how we actually can geographically aggregate all the data, because, some states have reserve cities, right? Which, whose number was actually increasing over time. So we aggregated the reserve city level, bank balance sheet to the level of the state they belong to, okay? And then we only consider like lower 48 states, contiguous United States, excluding Hawaii and Alaska, because they are quite far from the rest of the United States. So we believe that, we wanted to focus on just contiguous United States where interbank market could work better. And we treat Washington, D.C. as a different state, okay? So if you look at the balance sheet variables, the categories were quite stable. For example, like this is the data for state of Alabama. You can see, there was one core report on October 21st, 1913. And there's another core report in January 13th, the next year. And there were 90 banks. You have all the numbers for loans and discount, overdraft, bonds for circulation, etc. Okay. So it's quite easy actually to aggregate, and these categories sometimes change over time, but you can actually kind of see where this new category comes from. So we had no big problem in terms of like aggregation. So we actually looked at the data, we collect all the data, and then we construct our measure of the number of banks of each state, and average capital rate, and deposit amount, and loans, and liquidity ratio, which is kind of the short-term plus cash plus specimen over the entire asset. So that, for example, like when risk goes up, like, of course, the banks have some motive for higher precautionary savings amount. So they raise their liquidity ratio. So that's why we kind of look at this ratio. And then, of course, because we care about like spatial transmission of a panic, one state to another. So we have to care about like Euclidean distance between different states. So we actually calculate the state like distance between different states with each state most populated cities. So New York City is the most popular city in state of New York. And for example, Chicago would be the most popular city in Illinois. So we calculate the Euclidean distance between New York City and Chicago. Okay. And then, we borrow the banking panic categorization from Jalil's paper. So Jalil is very great paper because he categorized all the different banking panics across our sample period. And then, for example, like there were 3 major panics in our sample. Okay. First one was in 1873, which stemmed from Europe, and then engulfed the entire United States. And then, 1893 major panic was discussed by very nice papers by Kirsten and columnist and Carson. So this panic was widely known in the literature, I believe. And then, for example, like columnist Carson paper kind of discussed about suspension of convertibility at that time from New York City banks that kind of affected all the different banks in other states. Okay, and then like you can see, so this crisis engulfed the entire states across the United States. And there is another major panic which started in 1907 and which stems from New York. So these 3 banks, three panics were known as engulfing, as I said, the entire United States. So yeah, so this was quite significant panic. And then there are other panic series which he calls minor panic. For example, like 1884 panic started from New York and affected Pennsylvania and New Jersey. And, this 1896 panic started from Illinois, Chicago, and it affected Minnesota and Wisconsin. Okay. So all these minor panics actually can be a good thing to look at from our perspective because we care about like state level banking panic, which affects other states. Okay, so we actually are going to focus on minor panics, which I will discuss more in detail in a minute. So yeah, so we actually look at this Jalil panic series and then merge this panic series to our digitized state level banking data. And then we look at how each panic affects different states. That's the whole kind of big picture of what we do in terms of empiric. Okay, so this is the deposit level in the United States, and this red line. This is, of course, UFTD trend because deposit level was growing up around the unit root rate. So this is, the trend in deposit. You can see, so these 3 red lines depict major panics, which I just explained. You can see, this is quite pro-cyclical, right? So there was huge drop in major panic. And then I constructed minor panics here, as I explained. And then you can see, like during minor panics, also deposit rate goes down, deposit level goes down. Okay. And then this is the data for the entire United States. And then this is the deposit rate, deposit level in New York. Of course, you have the trend. And then, during these major panics, you can see that deposit levels in New York also drops, right? And this is minor panics only related to New York. So there are a bunch of different minor panics which are not related to New York. And then, like you can see, in these minor panics that affected New York, you can see like deposit levels in New York actually dropped a lot. And then this black line is actually minor panics that did not affect New York. And still, you can see that New York deposit level actually could dropped a lot during other minor panics. So you can kind of get a sense that, okay, so some minor panics that happened in Illinois affected depositors in New York, right? But this is just suggestive, right? So we have to be more precise about like this effect. Okay, so nature of panics. So you have to think about whether panic is exogenous, right? Or correlated with other local state level economic conditions. For example, like, if deposit was already dropping over time, then it might have affected the happening of panic like in a state. So we have to kind of, technically speaking, we have to test it, whether the panic is exogenous event or explained by, local economic system. And there's some literature on this. So some papers look at like individual banks and say, oh, banks fundamental actually could explain like majority of panics, majority of like runs to individual banks. And some papers say, oh, actually, it's not about fundamental, it's about liquidity story, explain like a Diamond DB style. So there's some recent paper that looks at individual bank series and say, oh, fundamentals actually play a major role in driving like bank run. But if you look at the literature about this state level bank panic, represented by Jalil's paper, I think consensus is that these causes of state level panics are quite disconnected from the business cycle conditions. So the common triggers was like mismanagement of funds by their CEO or misappropriation of funds. So let's look at what Jalil said. So for 1884 minor panics that stemmed from New York, like there was some rumors had been circulating that its president had misappropriated funds for speculative purpose. Or, for 1896 panic that stemmed from Illinois, there was a large additional sum to a relative of one of the officers of the bank. So banks actually had loaned an amount that surpassed its like asset size, its liability side to one corporation. And yeah, that's it. So there was some nepotism in terms of like how they made loans to different firms and different banks. So it caused huge panics across a lot of depositors in the state, and then they kind of ran to the banks, and then they caused like panics. So overall, the consensus is that, okay, so there was some systemic reasons why we had panics at that time a lot. Due to, for example, like some of it can be attributed to the size of banks, because at the time, relative to like the economic size, their bank size was quite small. And as I said, like because of unit banking system, they could not expand their business outside their state border. So they had their own state level, like idiosyncratic risk on their balance sheet. And then there was no deposit insurance. There was no, diversification due to this unit banking system or like reserve system. But we wanted to test a little bit more precisely about this exogeneity test. Okay, so we do additional granular causality test where I is state and T is quarter. And we have like panic series, this is panic dummy at state I, quarter T. And then we wanted to see whether, the past behaviors of deposit growth and loan growth and number of banks growth could have explained whether the panic actually happens in given quarter. And there is a state fixed effect, there is a time fixed effect. Okay, so our test is, our null hypothesis is that all these things should have no explanatory power for panic, right? Because if that is the case, like we can at least say, oh, panic actually, passed this Granger causality test, which means that panic might be quite uncorrelated with the past economic situations in a given state, right? Because these are all state levels. And then once you test this with all the data set we constructed and the panic data from Jalil, we have that once we only consider minor panics, you can see that we cannot reject null, okay? But once we include like major panics or panics, okay, we actually reject the null. So, you can see that once major panic happens, like, of course, major panics do not happen like out of the blue, right? So because it basically affects all the states across the United States. So you can easily see like why it rejects null, basically. But if you only consider like minor panics, you cannot reject nulls in our sample. So we only consider like minor panics and regard minor panics as relatively exogenous event, following like Jolly's paper. Okay, so that's what we will use in empirical section. So we are going to use panic series as an exogenous event and then see how this panic in New York, for example, like affects deposit rate in California. Okay. So before I go to the empirical section, because we wanted to provide some theoretical framework that explains why this interbank market can, transmit some risk to different states. Okay, so our objective here is to model like interbank lending market featuring the geographical transmission of deposit shocks. So in the interest of time, let's just discuss this graph. Okay, so in our theoretical framework, there are n states. Okay, and each state has their representative bank. Each of these representative bank 1, bank 2, and bank n, it consists of their loan divisions and deposit divisions, okay? And deposit divisions get deposit from their local depositors, okay? So for example, state 1 is California, and deposit division of California bank gets deposit from depositors there. And then loan divisions make loans to their local, firms, which, demand loans from these banks. And then, there's a interbank market across different states. So deposit divisions 1, or deposit division of bank 1, bank of state 1 can make loans, loan over funds, to loan divisions in state 2 or state n. Okay. And of course, from loan division 2's perspective, it's great because loan division 2, sorry, can, look at all the rate, proposed by the different deposit divisions across different states, and then choose the best rate for them, right? And then if somehow deposit division 1 offered the lowest rate for their loan over fund, then of course loan division 2 is gonna get all the loan over funds from state 1. So this is how the model works, okay? Okay, so let's start from loan division, okay? Even if the model looks quite complicated, it's not. There are a bunch of like tricks we are employing to make it make it very nice in terms of like expressions, which we will transform to some empirical estimation equation. Okay, so loan divisions get some loan over funds from interbank market, and they make loans. The market is quite perfect competition. So you take rate as given, and then you make loans, and you get loan over fund, of course. And then I forgot to mention this. So time is continuous within a quarter. So there's different discretized quarters. And given quarter, like time is continuous. So we are kind of using both continuous time and discrete time to get some nice expression at the end, which you will see soon. Okay, so given quarter t, we have different time point tau. Okay, so you make loans at rate RFIT. This is the rate that firms face in state I, and this is the rate you face, okay, in an interbank market, and this is the money you borrow from the interbank market. Okay, because the market is competitive, right? So these two rates should be equal to each other, okay? Because there is no imperfect competition issue. As I said, these loan over funds, we assume that they are fungible, so they are substituted with each other. Basically, they are money, right? So you can access all the different banks, okay? So each bank N offers Ri of Ni of T of tau. Tau is the moment in a given quarter, T is quarter, and N is the offering bank state, and I is the current state, okay? So this rate is the rate charged by bank N to bank I. And then, you observe all the rates offered by, different banks, and then you choose the best rate, which means that you choose the minimum of all the rates that is offered to you. And then all these loanable funds come from this bank, right? So your loanable fund, this I is you, okay? And then you get all the loanable funds from bank N that offers the lowest rate for you. So because the money is fungible, right? And that is what loan divisions do, like in each state, okay? And let's move to deposit division. This is a little bit tricky. So deposit divisions, of course, they get deposit. We use N for index of deposit division. So depositors in state N give DNT to deposit divisions of N, okay? And there is some, like some production function of loanable funds, okay? So it's not very trivial to make loanable funds from the deposit, okay? So we assume that there is some kind of like transaction cost or transportation cost following the trade literature of fund. For example, like given deposit, okay? And this is the money you are willing to offer as a loans to state I, okay? But in order to do that, you have to pay like proportional cost, which is denoted by Z of Ni of T of tau, okay? And then we assume that this follows some Weibull distribution that has T and I as scale parameter and kappa as shape parameter. So in a nutshell, if T and I is higher, then it raises the average of Z. But going back to here, if Z is quite high, okay, then given your deposit rate, deposit level, it's more expensive to make a loaner fund to state I, right? Because this is multiplied by Z. Okay, so you can think of this Z as some realized shock to how hard it is for bank N to make a loaner fund to bank I, in a state I. Okay, and you can see we assume that alpha is greater than 1, which means that as D and T goes up, it means that your bank is kind of larger and larger, right? Then of course it should be easier for you to make the loaner funds to different banks across different states because you are kind of big bank. So we assume that alpha is greater than 1, which basically represent the economies of scale for banks in terms of making loanable funds to different states. Okay. So the reason we introduce continuous time here is that, this is random, right? But given like uniform interval, we can be sure that, this cross-sectional distribution should be equal to the X anti-distribution of Z. So we are actually using that property to get like nice formula later. Okay, so deposit division answers this optimizations. So they make loan to bank I. And as I said, they charge this RINIT, okay? But this market is quite competitive. So you as small bank, because we assume representative bank, so there are like infinite number of banks in a given state, okay? So you have no power over this rate, but you take this rate as given, okay? And then you have some monopsony power over deposit, okay? So, because there is only representative bank, so they get all the deposit. So they can collectively actually decide their rate on the deposit. This is not very, very important, but it makes the problem much, much simpler in a sense that it makes the problem concave so that we have nice optimum, like for each bank problem. So you get D and T, okay? But in order to get D and T, you have to pay some deposit rate, which is a inverse deposit supply curve. So for example, like in order to get higher amount of deposit, you have to pay higher deposit rate because depositors have their supply curve of deposit, right? So as monopsonists, you have to respect this deposit curve. Okay, and then you can solve this problem. In the interest of time, like let's kind of move faster. So at optimum, you can see that the rate you charge, your bank N, okay? Rate you charge to different bank, I, different bank means different state, is proportional to how hard it is for you to make a loaner fund, okay? Because this is transaction cost realization times some deposit rate proxy. Of course, you have to think about like elasticity of deposit supply. Okay. And then times d and t to the power of minus gamma alpha minus 1. But as I said, alpha is greater than 1. So you can see first, if you are a big bank, okay, because then you have more comparative advantage in terms of making loan of funds to different states. So you can actually lower rate, okay? Because as I said, going back here, alpha goes up, you can enjoy like economies of scale in terms of making loan of funds. So in equilibrium, you can actually lower the rate you charge to your counterparties. And then you can see when this rate, this draw of random transaction cost or transport cost turns out to be really high, then of course you have to charge higher rate, okay? Because it is hard, right? It is more costly to make a loan or fund. The reason we, as I said, I introduced this Weibull distribution. The good thing about the Weibull distribution is that the minimum of Weibull distribution with the same scale parameter is also Weibull distribution. That's why we introduced this Weibull distribution. Because going back to lending demand for state I, right now we look at I bank, because state I bank, like loan division bank, faces interbank rate, which is the minimum of this RINIT of tau, right? But because this is proportional to this random draw, which is, the following the Weibull distribution, you can actually have nice Weibull distribution that each loan divisions face in the interbank market. Okay, so you can see the rate each loan division of state I faces is random, of course, because Z is random. But this randomness is represented by some parameter phi of IT, and kappa is the same. So you can see that, so when other states gets bigger, because alpha is greater than 1, because the exponent is minus, so this phi goes down, which means that you actually have lower rate on average because some banks in Missouri is really big. Okay, I'm a bank in California. Then there is some likelihood that this Missouri bank actually are gonna offer me really good rate. So on average, of course, there's other chance that I might choose different banks, but on average, you see that I will face good rate. Okay. And then the last step in theory is that we assume that the demand for lending to firms in state I is given by this decreasing function with the constant elasticity. So loan demand from firms in state I is decreasing function of the rate they face. Okay, but as I said, because lending division or loan divisions are in a perfect competition, this rate they charge to firms are equal to the rate. Where is it? The rate they face in interbank market. That's why I put F here, okay, instead of I, because they are the same. Okay, so the total, and also there is some loan demand shifter, which is kind of state specific shock. Okay, so the total lending demand in quarter T is then, because we have both continuous time and discrete time, so we just think about like quarterly data. Okay, so T is quarter. So the entire loan demand from firms in state I should be a time aggregation across different moments. And this loan demand is given by this, right? So RIT of F of tau to the power of minus beta and DT, and times some loan demand shifter. And you can see that, this is random, right? As I explained, the rate is random and follows Weibull distribution. But because we have nice continuous time, you can think about cross-section as an ex-ante distribution. So you can actually substitute this with the ex-ante expectation or average of rate to the power of minus beta. So you get nice expression finally. So you can express loan demand or loan amount made in state I as a function of all the different stuff. First, this is loan demand shifter of state I. Of course, they are proportional. And rho T was the average rate in the United States, let's say. So rho T is the average deposit rate in the United States. So when rho T goes up, of course, it is it is hard, it is more costly for bank N to get deposit. Okay, so actually loan in state I goes down. Okay, and then the most important information is here. So D, as I said, alpha is greater than 1. Okay, so alpha is greater than 1, which means that D in, the disease deposit in state N affects loan in state I in a positive way, you can see, right? And this TNI is as I say, like transaction cost, or this was actually a, scale parameter for waiver distribution of Z. And you can see that, when TNI goes up, then it is harder for bank N to make loaner fund to state I, right? And then you have lower loan amount made in state I. Okay, so you can see lending in each state I, thanks to this model interbank market, is possibly linked, connected to deposit in all the different states. Okay, and then you can see from this equation a beautiful trade-off coming from this interbank market. Let's say, let's ignore the heterogeneous deposit size. So let's say all the states have the same amount of deposit. Okay, when there's no interbank market, which corresponds to the case where T and I goes to infinity for different states of N and I. So it is impossible to make a loaner fund to different states. Then loan demand is determined by this. Okay, this is kind of benchmark. But once it becomes free to make a loaner fund to different states, let's say T and I is always 1 for different pair of N and I, then loan demand actually, increases by a factor of N to the power of beta over kappa, which is of course greater than 1. And N is 50, so it's quite large. So yeah, so you can see like on average, like credit supply actually goes up by this factor, but it means that loan demand becomes this factor times more volatile. So there is some trade-off between return or credit supply and the volatility of the credit. That's the key intuition we get out of this model. And then in the rest of the paper, we do estimate how severe and how persistent this spatial transmission of panic is. So we start from this equation and we linearize this equation. And then you can see that there is some effect from deposit in state N to loan in state I. And then because this is transaction cost, we assume that this depends on some geometry of state N and state I. So T and I is assumed to follow this formula. So distance between N and I should have effect. And once N and I are sharing their border, then there must be some bigger effect. And if N is equal to I, of course, it should have the biggest effect. And then here's the reduced form regression we do to get the quantitative effect of spatial transmission. Wait, I have like 3 minutes, right?
Yeah, no, so you can take a few more minutes, but I think in the interest of time, it'd be great if you could show your empirical results. We'd love to see them.
Finish. Sure. So I'm almost done. So yeah, so what we do is that, this is local projection, like Ayla Dordal 2005. So, as I explained, like we regard minor panics as exogenous event, because it passed our, Granger causality test and also following Jolly's intuition. And then you can see, we estimate this regression, you looking at number of banks and average capital, and deposits, loans, and liquidity ratio or logs. These are state level, like banking data about banking health, and then there's panic data, in different states for each minor panics. And then, as I said, like the geometry of different states should have some effect on the spatial transmission. And then, of course, you have to control like standard error, right? Like because there is spatial correlation, heteroscedasticity, and autocorrelation. So we use Drescher-Cray standard error. And then you kind of estimate this equation with all the digitized data. And then we draw impulse responses using like some random panic in New York. And then you get some predicted response in different states for different variables, okay? So this is the data for deposit. So you can see, like it has significant impact in first quarter, but it becomes insignificant after like 2 quarters. So spatial transmission becomes really, really strong, up to like 4%. Okay, so once panic happens in New York, actually California deposit rate actually drops by 4%. Okay, both in the origin and other states. And we do the same for loans, and it's similar. So you see, so after 1 quarter, 2 quarters, it becomes like minus 4% drop in all the states. Okay, even if we use just minor panics, which we regard as exogenous. And liquidity ratio is very interesting because, as I said, like you have higher motive for precautionary savings once you get hit by some panicking sentiment, right? So you can see that like once panic happens in a New York state, some neighboring states actually raise their liquidity ratio. But once you pass like 7 quarters, all the state actually start raising their liquidity ratio, which means that this sentiment is transmitted to different states. And this is average capital, it's similar. So we have like over 1.5 drops after 2 years in many other states, even after 2 years. So the results are quite significant, you can see. So number of banks is similar. So the last thing I want to just mention briefly is that, like in the previous regression we did, there is no special role played by New York, right? Like we estimate this regression, and then the only thing that matters is your geographical relationship with state of New York or state of origin state of panic. But for example, like if New York was very big state in terms of their finance, then a panic in New York must have like disproportionately higher impact on different states. So we actually control like this is deposit share at T-1. And if New York State had really disproportionately higher proportion of deposit in, across, compared to the entire United States, then the panic in that state must have higher propagation or higher impact on different states. And then surprisingly, this effect turns out to be quite small. So you can see that panic is more about sentiment instead of like size effect. So we have like other robustness checks, but yeah, we conclude that panic can be transmitted to different states in a very persistent and very significant way. That's the key takeaway from this paper. So thank you very much.
Thank you very much for the presentation. Very interesting paper, very interesting results. I realized I forgot to introduce myself at the beginning of the seminar. So I'm Kirsten Wandschneider from the University of Vienna, and I'm happy to, as I said before, host today's session. We are opening to Q&A. So we have a lot of participants. If anyone has a question for our author, then please write your question into the Q&A so that I can read and moderate it and relay it to Sanju. So while we're waiting for some questions to come in, I was actually wondering, because you rushed a little bit at the end, could you maybe go back to your really nice animated maps that show the key results from your local projections?
Right.
And I do have a question on the deposits. Maybe I didn't catch this right in time, but maybe you could show those again. And it looks like there are some inverse sort of spatial results. And do they come sort of from the way you specify the transaction costs in your model, or are they actually sort of additional regional effects or regional relations that you can?
I mean, okay, that's a great question, but I appreciate. So what we do here is to, we have no specific, so each state has no special rule. So what we only care, like in this regression, is their kind of relative position in the United States, right? So,
So you don't control for like size or anything. It's really just the spatial.
Right. So this is the benchmark regression, but of course in the paper we do additional robustness check, which turn out to be not that strong, So what matters is their relative kind of position in terms of geography, and then somehow this is just overall estimation result. So we are not sure about what is going on between, for example, state of California has bigger impact on deposit, than like Texas, right?
Mhm.
So there must be something going on, like in terms of like the data, but our estimation result says, oh, there is some result, like some significant impact on the far state from New York, and New York is not very special in this estimation. That's the thing I can say out of this result.
Mm. Can you play those results again?
Yeah,
I
sure,
really
sure.
liked your animation there.
Yeah, I spent enormous time like on drawing this, but
Yeah,
deposit is very interesting. Like if I say one more
yeah.
thing, deposit is very interesting because the results actually are gone after just 1, 2 quarters.
Mhm.
So it means that, depositors are quite quick in terms of catching the sentiment of the entire United States, and then they just run to the bank. So if you read like Jolly's appendix, which is like 100 pages long,
Yeah.
so he kind of documented what actually has happened like in each panic series. And then a lot of depositors actually had run to the banks and claimed their deposit. And then there was a lot of like suspension of convertibility because banks has no money. And so I think in terms of deposit, like it was quite quick spread across the United States. But going back to like liquidity ratio, banks actually are quite sluggish in terms of like adjusting their balance sheet, once panic actually affects their state. So you can see like it takes some time to affect the entire United States.
Yeah,
you know?
thank you. We do have a question from the audience here now, so I will read that out loud. It's from Tony Moore and comments, it's an interesting paper, and asks if the causal factor communicating minor panics across the states is sentiment, then would New York actually be more central or more important than it might appear by deposit share? And then he follows, could you look at, for example, circulation of newspapers to think about sort of the transmission of the sentiment, right? Do people sort of respond to New York more? And can we track this or see this in any way, maybe with newspapers?
That's okay. I mean, of course, we haven't done that,
Mm.
but that's really, really interesting comment, I think, because if this is actually a transmission of sentiment, especially about the deposit side, I think there must be some buzz in the newspaper or media at the time, right? Like, of course, there was no Financial Times at the time, but each state might have like newspapers, media, like outlet, which is more centered around the economy, and then they might kind of mention what is going on in different states, right? Like what is going on in New York, like in terms of banking, and then some like, some depositors read those news and then run to the banks, and it is kind of like it becomes known to other depositors. They might run to the banks. So we didn't look at because our model kind of give rise to quite kind of neat equation that connects like financial variable in state I to other states. So we just wanted to estimate that equation like directly using the data we have. But I think once we introduce this, for example, we can use like some passive machine learning or large language processing to get some sentiment data at that time, like in the historical context. Then I think we might have like more interesting like thing to say about how deposit in state N affects state I, right? So we can kind of use this sentiment measure as some intermediary between these two and say, oh, this sentiment was rising between this panic in state N and state I, right? And then we can say something more meaningful, I think. But yeah, I because we, like even this was quite, I think, hard. So maybe I should pursue that type of direction like after this project, maybe. But thanks for nice question.
We have another question from the audience here, Carlos Brando. Also nice, interesting paper, so complimenting on your paper. A minor technical question, how did you detrend the deposits? Correct? You showed the original
Oh, yeah.
deposit trend and
This one,
then the
right?
effect of the crisis. Yes, I think that's what he's referring to.
So, I mean, we did HP filter, or
Yeah.
and we did bunch of other detrending. For example, you can just use simple AR1 process and then you can just, like extract this epsilon, So whatever you do, like it doesn't matter that much. It becomes really procyclical, which means that one thing I found quite surprising is that, Jalil's papers say, oh, like minor panics actually are quite localized, which means that some panic in state in New York, like state of New York, affected only Illinois for one minor panic. But if you look at like this graph, like deposit in New York is affected a lot by minor panics that didn't affect New York, like at the surface. So there must be some mechanism about how like banks in New York actually face this type of like duress, in the presence of some panic in a far state, which didn't affect New York like per se, right? So that was the motivation for this project to, for us. So we kind of looked at this result and say, oh, there must be some like transmission mechanism like between different states, even if the panic didn't affect New York, like at the, as I said, like surface level. So, yeah.
Yeah, and Jalil builds on the narrative record, correct? So apparently then there was no narrative discussion of this link, but you're seeing it in the data.
Right.
Yeah, that's really interesting. Great. Okay, are there any other questions or comments from the audience? Oh, yes, Rui.
Yeah, that's me. Thanks, Wandschneider. Really interesting stuff. So, so two questions. One of interpretation and the other of estimation. Starting with the latter, right? So, you use state level data, and when you start with more disaggregated, you aggregate all the way to the state.
Right.
But US states are pretty big economic units, right?
Right.
And in terms of banking as well, right? Because there's big cities, small cities, even if they're not any reserve city in a state, right? There will be obvious agglomeration of finance in some cities and so on. So I wonder whether you're actually missing most of the action by using such highly aggregated data, right? So you probably know these papers, these recent papers about US banking networks, right? I'm thinking of, in particular, Chris Michener and Gary Richardson's paper.
Right.
So banks had correspondence relations, right? So you could actually drill down to the bank level rather than, just using these aggregate state level data. And I'm guessing, right, that this would be the appropriate level to do these kind of things. Now I know that in between there's something you call the interbank loan market, but I'm not really sure the US worked this way back then. This idea that there was some kind of competitive clearinghouse market everywhere that banks could exchange deposits against and so on, right? There was definitely a pyramidal system, right? So and all the money went up, right? So typically, as far as I understood, right? So money went upstream to the reserve cities where, for instance, it was placed in the coal loan market in New York, right? So I don't know if this, the data used is appropriate for the purpose. So that's question number one. Question number two. So you provide some very nice and smart micro foundations for spatial relation, right? In terms of originating deposits and so on. But the reduced form regression you end up running is not exactly surprising, right? Anyone would expect some kind of spatial effects,
right,
in banking relations. You provided a micro foundation, but I had trouble understanding, right? And sure, the results are stronger when you have the panics, the effects in the system, and then you have those nice maps and so on. But I wonder if you could tell me a little bit more. So what's the counterfactual here, right? So what does your theory let us understand about these spatial effects that we couldn't have hypothesized on our own? Thanks.
Okay, yeah, thanks for really deep questions. Let me start from your first question. So of course, there is some literature. I think still like people are working on like individual bank balance sheet data, and then they try to kind of understand what drives bank run, right? And then, of course, we could have done that, of course. And I mean, it entailed like, of course, it must entail like more work, of course, on our side. But the whole kind of motivation for this project was that we learned this Jalil paper, and Jalil paper is quite state specific. And because, he kind of talks a lot about these minor panics that affects different states. And then we wanted to kind of understand like this state level panics effect on other states. And then that's how this paper was born. So, and then as we kind of worked on this project, we realized that, okay, so maybe, we can do for the future project, we can do more about this individual bank kind of network, and then how that affects, one bank's run transmitted to different bank run, stuff like that. But I get some shortcomings of this state level, exercise or analysis, because as you said, maybe some stories are gone like during the process when you aggregate like different reserve cities to the state levels, and some state does not have like reserve cities, right? So, and one strong bank versus weak banks might feature like different behaviors, even if they are kind of bounded by the same state border, right? So of course, yeah, we acknowledge that, but I mean, we just still wanted to understand, like, how, like, of course, each state has their own jurisdiction in the United States at the time, and they still affect very far states. So that was the first thing we wanted to kind of show as a positive way, So this paper was more like positive paper instead of normative paper. We just didn't say much about like what they should have done to prevent this from happening. We just wanted to kind of give some number about how like banking panic in like state of Maine affects state of Illinois, right? So that's the first answer I can give you. Of course, we are actually looking at like individual bank balance sheet data these days, and then we are thinking about like writing new paper about this individual bank relationship, stuff, but it's a lot harder because you have to, there are a lot of missing data, and then it's quite hard to see whether this bank was in bank run or it was just facing like a larger deposit demand, stuff like that. So yeah, that's the first answer. And to your second question, which is also a very important question, like surprisingly, if you look at the literature, like theoretical literature about this banking, of course, the way we built our model is a little bit different from how it worked in the actual real world at the time, at the national banking era. I acknowledge that, because at the time, like there was like clear pyramidal structure, and deposit stipulation was a little bit different, right, across different layers, right? So we initially tried to build that type of model that looks like more like a actual pyramidal structure, and then it turns out that it's not very clean, in terms of like how model variables work. So surprisingly, like we looked at the literature, and there's not much, there are not many papers that explain like why interbank market can both raise the level of supply of credit, but also while they raise the level of credit, they kind of raise the risk of runs outside their state border. So our theory actually kind of like in a clean manner explains that trade-off. I explain like in an extreme case, I kind of differentiate between two, and then level of credit goes up, but the volatility also goes up by the same factor. So we wanted to kind of show that. And then, about how we can map this theory to the empirical section, I am sympathetic to your saying that, anyone can predict that there must be some special transmission. But going back to my answer for your first question, we just wanted to give some numbers, and then we have some clear numbers, which is significant, to different states. And then we also have so many different like robustness checks, and then the results do not deviate too much from this benchmark regression, surprisingly. So deposit share effect, like size effect, or the other effect, like, do not matter that much. So we...
Okay, sorry to interrupt you here. Thank you for the discussion. We have a few more questions in the queue, and I would invite people to take those over into the informal discussion. So we'll come to those in the informal discussion. We are unfortunately at the end of the official part of this. But before we close, I would like to remind everybody that there is one more presentation in this series coming in 2 weeks on December 11, and that'll be Marc Carlson from the Federal Reserve Board talking about the young Fed, the banking crises of the 1920s, and the making of a lender of last resort. So keep this in mind. Thank you, everybody. Thank you again for the very interesting presentation. And again, we'll move to the informal part now, where we can have more of an informal discussion, and we'll take the questions that are still in the chat then. Thank you very much.
Thank you. So,
Yeah,
I will actually go ahead and unmute. No, it won't let me do this. I have a question from I have a question from Patrick Hanan. Yes.
Patrick, yeah.
Hi. Yes. No, I found this very interesting, complicated model, but if I understood it correctly, it's really a model of interbank transmission.
Right.
That's really what you're interested in.
Right.
But as some the previous question sort of suggested, there's another mechanism which is sort of sentiment or information mechanism. And what I wanted to understand from do you think your empirics throw any light on whether it's the interbank mechanism or the sentiment mechanism is more important? Just to understand how, I mean, the model is all about interbank, though there may have been some sentiment hidden in there that I didn't notice.
So, okay, so like explicitly there is no sentiment in the model, like everything is driven by interbank market. And of course, the interbank market is hit by some like constant shock series, right? So as you see like here, this is kind of like transaction cost. We are interpreting this Z shock as how hard it is for you to make a loan to different state bank. But you can, and this shock kind of the like parameter that governs the distribution of this shock actually, you can see like affect all the thing here. You can see the loan in state I is affected by like this T and I parameter. And then you can think of this T and I as some kind of sentiment transmission, actually.
But if I could just, that sentiment, that's a set of banker sentiment. That sort of thing. Well, it's this very costly for me now to lend to Idaho because I'm hearing some bad news. But I don't see a depositor sentiment. I don't see
So
the Idaho guy is saying, oh, I heard some bad things, so I'm taking money out of the Idaho bank, even though, I'm not in the state that has problems.
That's very great comment. I appreciate it. I mean, we have no such thing, I think, like, because if you go to like depositor side, we just assume that depositors have their own supply curve, right? Like there is no sentiment here. For example, if there is a sentiment in the model, there must be another parameter that affects their supply curve of deposit, right? And if something happens in New York that raises that parameter, that lowers that sentiment, for example, that pushes down this entire demand curve, of deposit, then that might affect like, that will raise this RI, which is like interbank market rate, because it is harder for you to get deposit, at that time. Then, of course, that will lower like other states even more. So there must be some amplification mechanism, I think, if we include depositor sentiment. But as I said, we just wanted to focus on like interbank market. And then I think going back to the first question, like by one of the audiences, if you look at like, if you have like clear data about this sentiment, like I'm still thinking about like which sentiment data we have to use. Maybe I should read like newspapers data, right? I should do some narrative approach to the problem and then get some construct on my own like sentimental kind of index, right? At that time. And then maybe I can add this sentimental like measure here, and then we might have richer like implication of the model, I think. But you were right. Like basically, we abstract from that channel here. Only thing, the only sentiment that matters is the banker sentiment, as you put it. Yeah.
But then I think if you go back, I mean, you motivated everything with the Jalil study, correct? And he looks at the newspaper records. So
Right. And
You know, I
then,
think one way of maybe thinking about your study is you're finding these connections where the narrative evidence, at least according to his work, doesn't
right.
identify. But again, I think there are a lot of interesting questions to sort of go beyond. I actually
Right.
had a follow-up on your empirical section, because do you just look at the New York crises there? I mean, do you see a different pattern if you look at Illinois, or did
So, I mean, as I say, you know, like it doesn't matter. So you can start from like, what is this? This is Michigan, right? So you can start from Michigan, and then the pattern is gonna be the same.
okay?
Where is Michigan? Like Michigan is here. This is Illinois, right?
No,
So
Illinois is
No,
further
that's
down.
Minnesota. Yeah, be
Yeah.
careful
Yeah,
with the
that-
great state of Michigan.
okay, let's start from like, yeah, this state, let's say, and then of course what I'm saying is that the relative geography is the only thing that matters in this benchmark regression. But once we include this deposit share effect and the size effect of the state, then of course, you know, the fact that we started from New York starts to matter for the state, other propagation of a panic. But yeah, here, like the fact that we start from New York doesn't matter, you know.
But that's the prediction of the model, correct?
Yeah,
So
that's the
then the
prediction of the
interesting
model.
thing would be if you get different effects, you know, if you control for, because you have the deposits, right?
Yeah, so you know, like as I said, I because interest of time, I had only like 1 minute on this slide. But interesting thing is that we actually control this deposit share
Oh, yeah.
of
Okay.
state, you know, and then you of course use lagged variable because panic is kind of random, like in our mind, following Jalil. And then once you control this relative deposit size, it doesn't change the result that much. So that's why I started thinking about, okay, maybe this is not about, of course, you know, there are some papers in the literature that says fundamentals matter, as I explained in the intro side. But maybe, you know, this relative size like does not change the result that much. And then I recently got puzzled about, okay, maybe this is about sentiment, you know, like, so the fact that panic happened in New York versus panic happened in like smaller state does not change the effect on like state of Michigan in terms of like deposit size and loan size and every other measure. So yeah, so we actually try to like account for kind of different effect, and then it doesn't change that much from this benchmark result where we just control this relative geography. So yeah, so that's
Yeah, but if I may jump,
sure.
that surprised me a lot, right? Because I would expect some safe haven flows to go all the way to New York whenever the crisis started in San Francisco or somewhere else, right? You're stating that it doesn't matter where the panic starts, right? The spatial transmission just goes along geography, right? That surprised me.
Yeah,
But
that's
if
quite
you-
surprising. So I mean, we just in the current draft we just present that result as a robustness check for this benchmark result. But I realized recently that is quite surprising. You know, I mean, we are not doing anything artificial. We just run like new estimation based on this size effect, and then this size effect turns out to be quite weak. So yeah, so I started.
No, but it's not a side. Call it a quality effect, right? New York is different from everywhere else, right? So
Right.
if there was a crisis that started in Missouri, St.
Right.
Louis, Missouri, I would not expect that to draw away more deposits from New York. I would expect the reverse, that money would go to New York as the safe haven if New York was not involved in that. But
Right.
clearly, maybe I'm wrong, right? Because you tell me that.
Yeah, that was my prior as well, and then yeah, and it turns out not to be like that. So, I mean, this is just, I mean, maybe this is just estimated research, right? Like based on like state level banking data. So if we look at, as you suggested, if we actually write new paper based on like individual bank, you know, balance sheet data, maybe we find something more concrete about how each bank actually responds to panic in Missouri versus panic in New York, right? Because they are gonna look at like newspapers, and then their CFO is gonna make a decision on what they do, right? And then depositors are gonna be more sophisticated for some banks over another bank. So and my co-author kind of keep saying about this project, and we say, okay, that's it. So this paper talks about like state level propagation, and then we can work on more sophisticated data set like after this project. But yeah, I acknowledge all of your suggestions and
Right.
comments. Yeah.
It seems like there was one more question on sort of the connection of sort of the propagation of the crisis, and it seems like we discussed this already now. Are there any other comments from the group of participants that's still remaining, or any other questions for our presenter?
Doesn't look like, no.
Then I think we can close the session. Thank you very much again. I really appreciated the presentation and the following discussion. Very interesting perspective, and yeah, good luck with the project.
Yeah, thank you very much. And yeah, so if you have any question, please like feel free to email me, and then we can discuss more. So, and thanks for having me today. It was great.
Thank you. Thanks.
Thank you.
Thanks to both of you. Keep well and see you.
See you.
Bye.